And we're going to spend a few minutes now talking about ASU 2016-02, which is Topic 842, as I said, issued in February of 2016, really to bring consistency among treatment of similar contracts. So if you go back to the old days, the capital versus operating leases, which is the world we're still in, many folks have seen in their careers arrangements that were virtually identical that were treated differently because of very bright line requirements in lease accounting. So I remember instances over the years of clients who had in, say, 2008 would enter into a leasing arrangement for an asset, and the leasing company would come to them and say, well, do you want it on your balance sheet or not? And if you do, we'll tweak it by 0.5% this way, and it'll be a capital lease. And if you don't want this year's on your balance sheet, we can tweak it the other way by 0.5%, and it won't be on your balance sheet. And in substance, those were the same arrangements, but the accounting treatment became very different. So after years, a decade of discussion and deliberation, we finally have a leasing standard which should bring consistency to treatment for all of those contracts that are similar but maybe not quite identical. As you can see, the effective date for these contracts for public companies is fiscal years beginning after December 15, 2018, and non-public companies a year later. And one thing that we'll talk about over the next few minutes, the balance sheet impact is significant, and I think what we've focused on for the most part, many people have focused on in thinking about this. It's a gross up of my balance sheet. But we're going to talk a little bit too about how your income statement's going to change. Your cash flows for these leases won't be different, but your expenses and your treatment of the expenses will be a little bit different from what you may have been used to. So the first thing to talk about is really what is a lease. And Janice talked a lot in the revenue conversation about what's a contract for revenue. And a lease definition is really defined as a contract that allows an entity to control an identified piece of property, plant, or equipment that may be owned by another entity or titled to another entity. So what is that contract and what defines that contract? So an arrangement is really a lease or contains a lease if the underlying asset is explicitly or implicitly identified. And what they mean by implicitly is there's only one asset that could fulfill the obligation in that contract. So it may not call out the specific asset, but it's obvious to any reader of the contract what that asset may be. So if an asset is explicitly or implicitly identified and the right to use that asset is controlled by the customer in exchange for consideration, that's the definition of a lease. So it's not necessarily only things that you think of in your traditional lease arrangement. It's not just your vehicle lease or your equipment lease, but we have to dig a little bit deeper and get into this idea of what's an embedded lease that transfers the control of an asset to a customer as part of a contract where consideration is exchanged. So this is one of those topics. Embedded leases isn't new, but certainly is a topic that we could spend far more time unpacking examples of things embedded in service contracts that really constitute a lease. More time than we have today, certainly, but it's something to be thinking of as we go through this conversation and as you do your inventory. Don't stop at the obvious leases as we think about what we have to account for differently, but dig into those service contracts and think about what contracts do I have in place that allow me to control the use of the asset, defined as, do I get substantially all the economic benefits from the asset, and do I get to direct how it's used? Not just your traditional automobile lease as we normally think about. So as the FASB went back and forth on different models for leases, ultimately the goal was to align with the international standards, which would be all leases accounted for as one type of lease. And through our process, FASB ultimately settled in on a dual model for leases. We have what are called finance leases and operating leases. So a finance lease is something you would think of very similar to a capital lease, where we have our asset, our liability, and we have an amortization component and an interest component. And then operating leases, well, maybe similar to what we would call an operating lease today. The significant difference would be the asset and the liability will go on your balance sheet. So as we worked through this dual model, one thing to bear in mind is that the balance sheet component, as we'll see on the next slide, the balance sheet component for operating leases and finance leases is really essentially the same. We record a right to use an asset. We don't necessarily record the asset on our books like we might if we purchased it, but it's a right to use the asset, and we record a liability where we have to pay for the right to use that asset, and that's the net present value of those lease payments. So regardless of the difference between a finance lease and an operating lease, the balance sheet component is similar. Where we get into things a little bit differently is on the finance lease component, or on the income statement component, where, as you'll see, a finance lease, as we talked about, is much more like a capital lease. The expense is, I'll call it front-loaded. It's an interest method, so you have interest and amortization expense, two separate lines on your income statement, and through that interest method, you have a little bit higher expense for your leases at the front end, and at the back end of your lease, that tails off, whereas an operating lease is more of a traditional straight-line rent expense and will be accounted for on the P&L, again, similar to how you've typically accounted for a straight-line operating lease, although, again, balance sheet's going to look very different. So I do want to point out, though, that most of the commentary on these few slides is relative to the lessee side, and that's because most of the folks that, at least as a firm, we work with, and as we've observed who's on the webinar today, we don't see a significant number of folks who actually engage in leasing assets to others. So bear with me as I mostly gloss over and ignore the lessor side. I will say this: if you are on the lessor side and you get into the finance lease side, there is some considerations to get into as to whether it's a sales type lease where the asset comes off your books and the sales, the profit and loss is recorded at the commencement of the lease, or a direct financing lease where the actual recognition of any gain would be deferred until the end of the lease. So something that you would want to get into if you're on the leasing side and you're a lessor, but not something that we intended to get into today. The other thing to bear in mind is statement of cash flow treatment, where, again, you have operating and financing considerations for a finance lease. You have cash going out the door for the principal portion of your lease liability as a financing component, and the interest component. It's easy to say interesting, although most of you probably don't find it terribly interesting. The interest component is considered an operating expense, and operating leases would all be considered operating activities for your statement of cash flow. A few things that have been clarified and certainly points of discussion over the last decade as this standard has been bounced around and through exposure draft and re-exposure. And first is, what term do I use? So traditionally you would sit down and say, I have a 10-year lease with 2 5-year renewals. Do I include those 5-year renewals or not? And as you may recall, the first version of the leasing standard that came out in exposure draft said that you had to do a probability weighted model where you have to figure out what's the likelihood of using those extensions. And so you might have a 80% likelihood you're going to use one extension and a 40% likelihood you use the second, and you have to work back through a lattice model and say, I'm going to use 12.3 years for my life. A lot of outcry, a little bit ridiculous. So where we've settled in on the final standard is the idea that you would include that extension if significant economic incentive exists for you to exercise. So for instance, as you do your analysis of your lease life, if you've just put a significant capital improvement into your lease space, there's a high likelihood you wouldn't abandon that capital improvement, and so there's clearly economic incentive to stay. If you're in a long-term lease with renewal options that are better than current market rates, there's obviously an economic incentive to stay. Why would you leave and go pay higher rates to go to a different facility or different space? So it's that idea of, how do I define significant economic incentive? And that is something that certainly requires judgment, but I would say a reasonable person would generally come to the same conclusion as to whether something does or does not indicate economic incentive to extend. There is an exemption for short-term leases. A lessee may elect not to apply the requirements of 842 to short-term leases. And if you do make this, and short-term being defined as it says, 12 months or less, if you do make this election and choose to treat those more on an ongoing month-by-month basis. You have to make that election by class of underlying assets. So if you choose to treat, say, short-term leases for computers or cell phones, things that are regularly maybe upgraded, you can't treat some of them one way and others another way. It's treated by class of asset, and once you make that election, you continue on that path. So those expenses will be recognized on a straight line basis over the lease term, and any variability in the payments you would record in the period which the obligation is incurred. So when that variability is experienced, you record the expense at that point. Another item to think about regarding related party leases, that's often a question, and frequently related party leases, as we see, are not very well documented, but related party leases do need to be analyzed under this topic, and we need to understand what the implications of the lease arrangements are, what kind of documentation exists, what kind of history exists between the related parties. So there is no obvious answer for related party leases, but I encourage you to take some time and make sure you understand the implication on related party leases that may be in place in your organization. And finally, there is some clarity, as there was not in the past, on what rate of interest to use when determining some of these calculations for your P&L and the interest expense, and how to record the present value. So flying through about 4 hours worth of content in 8 minutes, I do want to focus most of our conversation, though, on what I think is the most important thing, and that is where I started our conversation. We are now a year and a half into the standard being issued, and we have high confidence that most of you have already started the process of preparing for transition, but it's not that far away, and if you haven't started, I really do encourage that you begin that process as we roll into fall here, and have a plan in place for the next year so that we're ready to implement. So step one, develop a list of all those existing contracts. That's, again, not just lease contracts as you traditionally think of them, but make sure we scour the existing contracts, service contracts that we have and such, to ensure that where we may have control over assets embedded in those service contracts, that we understand how to account for those and how to carve those out. As you enter into new lease agreements going forward, make sure you start to catalog those and add them to the list of your existing lease arrangements and your lease contracts. Once we understand what all the leases that we have in place are, we need to determine how we're going to capture the journal entries necessary, how we're going to capture the calculations and the library of information necessary for transition. There are third-party leasing software available to do all this, much like traditional fixed asset software. Smaller organizations with a more confined number of leases may find Excel works perfectly well for this, and I believe that the majority of our clients will probably lean that way, although those folks in the retail or large manufacturing with heavy leasing may find that the software is just a much more user-friendly process and give you the right answer every time. We need to understand the financial implications. What does the transition look like? As we talked about a few moments ago, it's a balance sheet gross up, but it also changes the character of my income statement and when income gets or when expense gets recognized. And there will be an impact on ratios. And so I need to understand how do my both balance sheet and income state based and cash flow based ratios change. So when my stakeholders, my banks, are looking at current ratio and debt service coverage and looking at EBITDA measures, how does this standard change the way that some of those measurements are calculated, and how might that impact the covenants I'm bound by or the way the industry evaluates my business against my peers? And once we understand those implications, I think number 5 is probably the most important thing, and that's to have the conversations with your lenders, your bonding agents, the stakeholders in your organization, those who look at the metrics and ratios and need to know now that in a year or two they're going to see very different numbers coming out of your organization when in all economic substance the transactions haven't changed a bit. So we need to have that communication soon and often, and that's something that should start hopefully this fall and into early winter as you start opening the door for the conversations with those who are going to be impacted by these changes.